Hello and welcome to Why Not Mint Money. This is Neil Borate from the Mint Money team, and today I'm joined by Rajeev Radhakrishnan, who's the head of fixed income at SBI Mutual Fund. Welcome, Rajeev.
Thank you, Neil.
So, Rajeev, my first question is that with inflation north of 7%, how can investors get real returns in fixed income?
Yeah, I think what one needs to distinguish here is the inflation number that we are seeing in the recent past is largely one-off due to certain uptake in vegetable prices and some food articles. So what's important for an investor is the average expected inflation over the time horizon in which you would be investing in. So if you're looking at a 1 year plus expected inflation projection, they are still within the 4 handle. So I believe even today, given the current level of yields, there is still a real positive yield available to investors through investments in fixed income products.
Which debt fund segment is best suited for investors in terms of risk reward? So you mentioned that one thing you can look at is the spread between AAA and AA.
Right.
So, which segment looks the most attractive?
How I would answer that is one should really be looking at fixed income from an asset allocation angle. Instead of trying to move among various fixed income categories depending on what is the flavor of the moment. So I would say that whether the short term to medium term segment, which is broadly in terms of interest rate risk, you are between the 3 to 4 year space. I think these category of funds should be part of your portfolio all across interest rate cycles, because I think that's where the discipline comes in. Because if you try moving among various categories depending on what is the flavor of the month, and that's where you probably tend to make mistakes. So what I would advise is that for the fixed income space, investors should really have an asset allocation in mind. You decide to what extent you can invest in fixed income. Let short to medium term the short term funds, which are largely a high credit portfolio, and medium term funds which on an average are in the AA plus handle in terms of credit exposure. I would say these two categories should be part of the portfolio across rate cycles, and today is no different. So today, if you ask me where investors can stay invested in the fixed income category, and I would say this should be the core allocation in your portfolio. Of course, depending on the interest rate cycles, you can either have a certain allocation to FMPs or into duration funds, depending on where the rate dynamics are. But the core portfolio should consist largely of short to medium term category of products.
Sure. At the very short end, two categories have changed, and there's also been an introduction. So overnight funds came in after SEBI's decategorization. And liquid funds have now been subject to a lot of restrictions. So for an individual investor who's doing, say, an STP from a short duration fund into equity, should he avoid these two categories and maybe look at ultra short?
Yeah, I think we've already seen that shift. So to an extent, I would say we've seen already. So when these regulatory changes came in, the overnight category grew, and I guess it will grow again because 1st April some more set of regulations would come into play. So we've seen the overnight segment grow, which is largely institutional in nature. At the same time, a part of the liquid fund allocation has shifted into the ultra short. And ultra short is a 3 to 6 month bucket product where you get a marginally higher accrual compared to where the liquid funds are. And I guess for retail investors, especially who do a switch into a different category, equity effectively from that fixed income space, I guess the ultra short category would be a very good product to fulfill that particular investment requirement.
That's it for this edition of Why Not Mint Money. Thank you, Rajeev.
Thank you, Neil.
Thanks for watching.
Thank you.